You're now listening to episode 109 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi everyone, thanks for tuning in. Thomas Castelli here today with Kevin Jerr, EVP at Cost Segregation Services Inc, or simply CSSI Inc. Kevin spoke at our first ever Tax and Legal Summit and is a nationally recognized speaker and expert on cost segregation, tangible property regulations, and the real estate professional status. In today's episode, we discuss the tangible property regulations, including safe harbors, partial asset dispositions, how they intertwine with cost segregation studies, as well as the real estate professional status, common misconceptions, and much more. Hey, Kevin, thanks so much for taking the time to come on the show today. Would you be able to give our listeners a little information on your background and how you got involved with real estate and cost segregation?
Yeah, sure. Happy to. Thank you for having me. I didn't really start my career in real estate taxation. I was actually 180 degrees opposite. I was a salesperson for Fortune 500 companies like Hewlett-Packard, and then kind of stumbled on tax about 10 or 12 years ago and just kind of fell in love with it. And so I immersed myself in it, got my master's degree in real estate taxation, and then I actually was focused on cost segregation, and then the tangible property regulations, which came out in 2015, kind of really lit me up. And so I immersed myself, found the foremost authority on the tangible property regulations. His name was Eric Wallace, and Eric and I became friends. We worked on several very, very large projects. And it kind of dawned on me that how cost segregation and the tangible property regulations really do work well together. And so that's what I've been doing for the last 5 years, is focus on cost segregation, but also how the TPRs really interact with that and preclude cost segregation. And so that's kind of what I've been doing. I've done many large projects with Eric and I. And we really have made a difference in a lot of not only CPAs, but building owners and investors in their understanding of the regulations, which are very much in their favor.
Absolutely. Speaking of the TPRs, they did come out, a few years back, as you had mentioned, and they made significant changes to the treatment of the costs associated when acquiring, maintaining, and improving and disposing of tangible property, which is, of course, a big deal for real estate investors. And there's a lot there. Would you be able to point out maybe the top, 2 or 3 most impactful takeaways for real estate investors introduced in that bill?
Yeah, sure. Be happy to. So I would think some of the top the top issues or opportunities that come up that very, very few owners or investors have even heard of is the fact that on a depreciation schedule or on a building, if any expenditures are on that schedule that let's say it's and can be deemed a repair, you can actually go back, create a negative 41A adjustment, and get those off of your schedule. And I think a lot of CPAs tend to ignore that and think, what, if I go back and there's like a roof repair, let's say for $100,000, that if was done today could be expensed. I don't want to go back. I don't want to scrub the schedules. I don't want to get that off because it's going to create red flags or possibly an audit risk or whatever. But there is so many opportunities that I see every day of expenditures that were done 15, 20 years ago that can be scrubbed off the schedule. And a lot of times there may not be a basis left. But remember, when you take an expenditure that's being depreciated and now you expense it, you have no recapture on the sale, when you sell your building. And even though there may not be a huge opportunity and maybe the expenditure is fully depreciated, but that doesn't mean the benefit's not there, because when the building is sold, the basis is increased and the less capital gains you pay. In fact, I was working with a CPA out of Indianapolis, and we actually took an owner of 4 or 5 multifamily properties, and we took her from I think a 20% capital gains rate down to zero. We got her capital gains down to, under 78,000 just because we scrubbed the schedule and got items off that would have dropped her basis and increased her capital gains. And we were able to really, really get that schedule down to where it would be. The other part that jumps out at me is a lot of CPAs feel that the TPRs are optional. Well, cost segregation is totally optional. You don't want to do it. You want to overpay your taxes. Fine. The IRS isn't going to, send you any letters. But these are not optional. These are the law. And if you don't follow them in the future, you will be out of compliance. The IRS can disallow future depreciation because the income could be misstated, and that I kind of point fingers at the AICPA sometimes, but they did a really poor job in really getting the information out. So they are very much in the taxpayer's benefit. They can help them when they sell their building, but also it's the carrot and the stick. The carrot is to be able to take advantage of these regulations. The stick is if you don't, then the IRS could come down on you, with penalties and interest.
Mm-hmm. No, absolutely. And that's why here at the Real Estate CPA, we make sure to always, we take the tangible property regulations very seriously in both our advisory engagements as well as when we're preparing the tax returns for our clients, because we understand how important this is. And there's a few other items that kind of came up in the tangible property regulations, some safe harbors that actually help out investors a lot. One of them being the de minimis safe harbor, which allows investors to essentially expense, to your point before, expense items that are under $2,500 per invoice line item. Would you have what's your take on the de minimis safe harbor, and how have you seen it help investors?
Yeah, the de minimis is kind of a low-hanging fruit. All CPAs have software now, and the de minimis is one of the safe harbors that most of them will take advantage of. Remember that $2,500 does not have to stay at $2,500. If you're a large corporation and your average expenditure is $10,000, the onus is on you to prove that that $10,000 is actually a very small expenditure. So that $2,500 is just kind of thrown out there. But if your expenditures are typically well over that number, you can raise that de minimis safe harbor to whatever you want. The ones that are really ignored is the small taxpayer safe harbor. And so if in my example of my CPA in Indianapolis and her client, she owns several multifamily properties, apartment complexes with 10, 11 buildings on that complex. So what the small taxpayer safe harbor is, and it's designed as an administrative convenience by the service, because they don't really want to put an onus and a burden on small taxpayers, is you can take the lesser of 2% or $10,000 for each of those buildings, and you can expense whatever you want. So every year you would elect into it, and you would have the lesser of 2% or 10% for each of those buildings in the complex. But you start doing, replacing windows and doors, or as tenants move out, you have to replace carpeting. You've got that safe harbor that you can use in each of those buildings. But by far the most misunderstood is routine maintenance safe harbor, and this is nothing new. The regulations are really nothing catastrophically new. They just take some of the old regulations that if you could call an expenditure or repair, you would always be able to expense it. And if you were doing something routinely to keep your building or asset in its everyday operating condition, that could always be expensed. But the routine maintenance says that if you're doing any kind of routine maintenance on your building, that's going to be done again in 10 years. And the interesting thing is you don't even have to do it in 10 years. You just have to have the intent of doing it in 10 years. It could be a $200,000 expenditure. And as long as you're keeping your building or component in its normal everyday operating condition, you can expense that. And all you have to do is, you don't even have to do a 3115. You don't have to do a change of method of accounting. You don't have to do an annual election. The investor is already deemed to be following this. you just need to attach something to your tax return saying, hey, I'm going to be doing this again in 10 years based on my experience, based on the component's life or the warranty, and you can expense that. And I've really yet to see any tax professional really utilize that the way it was intended. But that is such low-hanging fruit. It's so easy, and it could mean a world of difference, especially now that with COVID, to be able to actually, you can go back in time and use routine maintenance safe harbor. That's the only safe harbor you can go back with. So the safe harbors are a phenomenal opportunity, but my gosh, they are being ignored, except for de minimis. The other two are just, in my opinion, being ignored by 80 to 90% of the tax professionals out there.
100%. I mean, I would agree with that statement, and kind of just drilling into the routine maintenance safe harbor for a second. Would you say that it's fair to say that, if say you own an apartment building and if people live in apartment buildings for a handful of years, they might move out, and you have to go ahead and turn the unit. When you go in there and you have to replace the carpeting or the flooring or the windows or any number of things that would be routinely replaced during a unit turn, would you consider that to be under the routine maintenance safe harbor?
Yeah, that's one of the things. The routine maintenance safe harbor is very, very broad, and again, it's designed to keep something in its everyday operating condition. Now, with your example, and that's a really good example because it does kind of open up the rest of the regulations beyond the safe harbor. So let's say you own a multifamily apartment complex with four rentals, and one person moves out. The regulations actually say beyond the safe harbor, then 33% of your building is being impacted. And if you have four renters and you just take out one, then that's 25%. So anything less than 33%, if you're a landlord, can be expensed. So even if the safe harbors don't apply, there are other ways to be able to expense those expenditures in and above the safe harbors. So the example you used is a good one, and it really does kind of open things up. So as long as you're not making the interior materially better, or if let's say an HVAC unit every 6 or 7 years it has to have a major service, and you do that service and you're not making it better, it's routine maintenance. But even if you don't fall under the routine maintenance, there are 2 or 3 other ways to be able to still expense that. The biggest one is the 33% rule.
Exactly. I've heard, that's an excellent point. And basically, I think you might have cut out there for a second, but basically what you had said was that if you're doing any repairs or maintenance or any improvements that are under 33% of the entire property, basically you could just expense that rather than having to capitalize that.
Yep, that's exactly right.
So something else that's in the TPRs is the partial asset dispositions, and I know this plays a key role with some considerations with cost segregation. Would you be able to just give us a quick overview of what a partial asset disposition is and why it's so beneficial for investors?
Yeah, I would, and that's a key point. And again, this is another aspect of the tangible property regulations that most CPAs they miss. So let's say you've got a building which is the asset, and you're doing a renovation, and you're taking a portion of that asset and you're disposing it. Let's say you're renovating and throwing out drywall or roof or electrical or carpeting, whatever. Well, what you throw out may not have a value to the owner or investor. They just want to get it out of there. But from a tax standpoint, it's part of the asset. So the asset has a basis, and what you dispose of is a portion of that basis. And from a tax standpoint, you can take a one-time expense in the year it was done and actually, take a one-time expense and have a write-down of all the garbage that you got rid of. So, anything that goes in the dumpster actually has a value from a tax standpoint. Now, somebody's got to put a value on it, and your CPA is not able to put a value on, how much drywall and electrical and plumbing and everything that was disposed of. But that's what an engineering firm like ours would do. Where this is missed is CPAs don't understand that they can't really put a value on the basis that was disposed of without a cost segregation study. And so what happens is if it's not done in the year that these assets were disposed of in the calendar year, it's gone forever. And I see very, very few investors taking advantage of it when they dispose of an asset to actually take a write down on the adjusted basis of that asset. The other portion of that is under these regulations, the removal costs can be expensed. So if you are doing any kind of renovations or have done in 19, if I always tell clients, get your general contractor to separate the cost of removal and the cost of the new asset coming in. And they're not going to like that because they make a lot of money on the disposal and removal costs. So they may not want to disclose that to you, but you're the boss, you're the client. You can tell them to separate it any way you want. So we've got, if you are doing a renovation and disposing of a portion of your building, you can expense everything that was thrown in the dumpster, and also you can expense the cost of removal. You don't have to capitalize that, and that is missed. And I'm just guessing at percentages, but probably 95% of the time.
Yeah, no, I mean, I would have to agree. I mean, we see this type of stuff coming from other CPAs all the time. People always, kind of missing out on these opportunities, and it's always something we try to point out to our clients here. And that kind of brings up a question related to cost segregation. And we've gotten a few different answers from different professionals in the cost segregation space about this. But when is the ideal time to have a cost segregation study performed? Because I think to your point, if you're going to be doing a major renovation, you might want to identify the cost breakdown of some of these items you're disposing before you make these improvements. But we've also heard that some people say that you should go ahead and make all your improvements and then get the cost segregation study performed. So I guess my question really is, when's the best time to have this done? Is it at the time of acquisition or after the renovations have been performed, or is there no true right answer for that question?
Yeah, you've actually asked kind of two different questions. When should you get a cost segregation done? I would say get a cost segregation done when you need it the most. When you need to get out of jail free, when you got a large tax liability, or you're having a great year and your taxes, you're in a 37% tax bracket. Get your cost segregation done. It's pure timing. As far as the renovation, if you have had a cost segregation done, I would get the cost segregation firm involved immediately, so that send them the AIA construction document, tell them what your plans are, so that they may be able to do a site survey, which is a fancy name of just taking pictures, and to be able to document what assets were disposed of, and then the new one coming in, they can cost segregate that again. So to get a cost seg done whenever you really need it the most, that's when I would say to do it. As far as if you are doing major renovations and you haven't had a cost seg done, you absolutely have to get it done. If you have one already, then keep your cost seg company involved and take pictures and memorialize everything that you may need in case it's ever questioned.
No, that makes a lot of sense. So thank you for that answer. And kind of something else that's involved with cost segregation studies. And I know you also, I believe you're an expert on this as well. I've seen some of the CPEs you've had out there. Is the real estate professional status. And, of course, a lot of people want to achieve the real estate professional status so that when they run a cost segregation study, to your point, when they need it, that those losses can actually offset their active or non-passive income. And we work with a lot of different people out there, and there's a lot of misconceptions on what actually qualifies towards the hourly requirements for this for the real estate professional status. And would you mind if we got your take on some of these questions we have out there for this?
No, I'd be happy to. I did a CPE about a year ago, and it was re-recorded, and I think there were 15,000 attendees. This is not a new law. This has been around for so misunderstood. And when I was in grad school, we went over 500 cases on the real estate professional, and where clients and building owners got it wrong. And, they kind of skate by and think that, well, I do this, partially full time, or I own 10 properties, or I own expensive properties. So I am a real estate professional, and the IRS wins, I think, 299 out of 300 times. So if you have any specific questions, I'm more than happy to answer those. If you just want my take for a couple minutes on the requirement to actually become a real estate professional, we can go down that road too.
Well, if we could, do you think it'd be all right if we got your take on it? Then I just asked. I have like maybe 2 or 3 questions, specific questions on what qualifies.
Sure. Go ahead.
All right. So, one of the questions we have is does education count? Like time spent. Like a lot of people come to us and they want to qualify. They want to count their time listening to podcasts or books or attending seminars towards the real estate professional status. And do you have an opinion on that one way or another?
I just go by court cases, and that absolutely does not qualify. And the same as if you're researching, cheaper mortgages or cheaper debt, or meeting with a bank on restructuring your debt, or doing your financials. None of that qualifies. And that is that's a great question, because I would say that's probably the second or third most common misconceptions, is that I can, all of the time I spend, managing the financial side of my property or going to seminars counts, and it absolutely does not. And the courts are very, very clear on that.
Yeah, absolutely. And then another question kind of related to the research, we're also under the impression that time spent researching properties on the MLS or just in general researching properties that you may acquire, that time also doesn't count as well.
No, that does not. Now, that's an interesting scenario, because under the tangible property regulations, you can expense that time. That is that time of researching. If you want to buy a property or not, actually, is something that does not have to be capitalized. But on a real estate professional status, no, that absolutely does not count.
Understood. So, all that being said, the one thing I always try to make clear to people who want to qualify for the real estate professional status is that, the entire reason, from at least my understanding, this was put in place in the first place, was to stop people who just dabble in real estate, part time, from being able just to just take all the depreciation expense, that creates a loss, against their non-passive income. And to actually qualify as a real estate professional, you need to actually become a real estate professional. And it's not just something you can go read a few books on or kind of like I said, dabble in. So I guess what would be your take on what someone needs to do to qualify, in general as a real estate professional?
Yeah, and I love the way you frame that question. Is so many clients will call me and ask me, well, how do I become a real estate professional? And I don't mean to be flippant. It's like, well, become a real estate professional. To be a real estate professional, actually be a real estate for a living. So the criteria is actually pretty clear. First of all, you have to have a real property trade or business, and if you have rental properties, that's good. The second step is you've got to spend at least 750 hours managing the property, not doing research, but actually managing. And the interesting thing is, commuting time and drive time does count. So if you're shoveling snow or fixing a toilet or fixing a roof or whatever, or hiring a contractor and being on site, all that counts, but it's got to be 750 hours. But the tough one is the 50% rule. So in addition to the 750 hours, you must spend at least 50% of your personal service time managing your rentals. And the examples that the IRS uses is they were trying to stop tax shelters, where a doctor, would have his doctor practice and own some rentals, and through depreciation and non-cash expenses like that, he would be able to offset his doctor income, and that was a tax shelter. So all tax shelters went away in 1986. So and then after that, and this is where the IRS will really get you, is you have to materially participate in each rental. So the first step is got to be in a real property trade or business, and if you own rentals, that's good. The second step is you have to spend at least managing your rentals. The third step is you really can't have another W-2 job or another job that's non-real estate related and spend 50% of your hours, managing that rental. But the fourth step is materially participating. And as you know, it's pretty easy to materially participate in really any in any business. It's a lot easier than the 750-hour rule. But the regulations say you've got to materially participate in each one. So I think there's 10 or 11 different ways to materially participate. But unless you can prove you materially participate in each one, the IRS will flag it, and your real estate professional status will be thrown out. But what you can do is you can aggregate all of your rentals for step 4, where you put a statement to the IRS saying, I'm under the real estate professional, I'm aggregating all rentals for material participation. And then that way you just have to materially participate in all of them together. And I'm thinking it's like 10 to 15% of the cases out there are from clients or investors who own buildings. They meet the 750-hour rule, they meet the 50% rule, but their CPA forgot to put the statement on their tax return. And now the IRS is saying, okay, tell me how you materially participate. You spend 100 hours on each one. Are you spending more hours than anybody else on each property? And unless you hit them all, the IRS will deny that. So those are the 4 steps, and that's why it's so misunderstood, because you've got the 750-hour rule, and then a step 2, and then step 4, you have the material participation rule. Everybody thinks that's the same, or they get them mixed up, or get the numbers mixed up, and then from there the IRS has easy pickings.
I absolutely, and I thank you for clearing a lot of that up, because there's a lot of people who just coming to us and just are they're very strongly under the belief that education counts, and we tell them, and they don't want to take no for an answer, and like I said, I thank you for clearing that up. So, and I know a lot of our clients have used CSSI for cost segregation studies, and you do have a link that we will drop down in the show notes for anybody who wants a free analysis. Would you be able to talk a little bit more about what they would get if they what happens after they would go ahead and fill out that link?
Yeah, it's a link to get us the information on your property, what kind of property it was when it was put in service. But it's going to go to me personally, and I'm going to look at this depreciation schedule. And first of all, under the TPRs, I'm going to look for any expenditure that can be expensed and under the TPRs, and get that off of the schedule. And then what's remaining, we will calculate the accelerated depreciation lives. They're for 5 years and 15 years. The 5 years is really anything inside the building. The 15 years is all your land improvements. We'll do a calculation on that, and it will give you a cash flow analysis of what the tax savings would be, or the tax deferral would be, and along with our flat fee. And then it's up to you and your CPA whether this makes sense or not. Whether again, the real estate professional status plays such a huge role. It's it may not be. You may not be in a 37% tax category. You may just be a passive investor, and our depreciation would offset your passive income. So we're going to take all that into consideration. I may actually pick up the phone and call the person who put their numbers in, or their information in, and just get a kind of a lay of the land. What's your tax bracket? Is it active versus passive? And then get some clarification on maybe some line items that we think we can expense based on the TPRs. And then from there, it just becomes easy. Our tax people will give an analysis on what the tax deferral would be, what the savings would be for the TPRs, and what our costs are. And then it's just a matter, again, of timing. Does it make sense?
Absolutely. And we thank you for that link again, everybody who's listening. That will be in the show notes. So, Kevin, it's been great having you on today. If our listeners, wanted to get in touch with you directly, or wanted to otherwise learn about CSSI, what would be the best way for them to do so?
If they don't mind, I'm old school, Thomas. It's just pick up the phone and call me. I think my number's in the show notes, or if you want, I can give it to you right now. Email is fine. It's JERRYK at COSTSEGSERV.com. I hate that email address. It's so complicated. Nobody gets it right. So I just, pick up the phone, call me, or you can even text me and say, hey, can you call me tomorrow at 3:00? Our conversations last 5 minutes, but it'll really help me understand your listener's situation instead of just sending a blanket analysis that really doesn't take advantage of all the facts that are there. So will you have my phone number in the show notes, Tom?
Yeah, absolutely. We're going to go ahead and drop it in the show notes. Everything's going to be down there. But if you want to go ahead and give it out here on the air, that's that works as well. Make sure everybody has it.
Oh, more than happy to. Thank you for the opportunity. It's area code 502-216-5941. I'll say that again, 502-216-5941. And I'm in Phoenix, Arizona, where it's 120 degrees right now. So just note that I'm on Western time, but I'm usually on my phone 7 days a week, 24/7.
Absolutely. Kevin, thanks again for coming on. It's been amazing. Thank you for clearing up some of these common misconceptions out here. People are under, and like I said, everything's to be in the show notes, and we're looking forward to putting this out there.
No, thank you. I love explaining these things, and you guys have been a great partner to us. And if you ever want to have me on again, just tell me what you want me to talk about, and I'm more than happy to jump on. I'd love talking to you guys.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.